Does retail really see it? All of this will be answered in the next part, where I will show you the real face of the market between 9:15 and 9:30 and the 3 signals that are essential before taking a trade. Retail traders watch candles. Pro traders read the intention behind the candles. If you think a green candle means buy and a red candle means sell, stop right here. Because that mindset is exactly what makes you late in the market every single day. Truthfully, between 9:15 and 9:30, the market does not give you signals. The market tests you, and whoever fails this test, their money becomes profit on someone else's screen. I know what you do. 9:15 the market opens. The first candle moves fast. Your heart says, don't miss the move, and your finger jumps to buy or sell. This is exactly where retail loses. Because a pro trader does not try to catch the move. They try to catch the intention. One day I intentionally did not take a trade between 9:15 and 9:30. The screen was on, the market was running. My heart was screaming, take the entry, take the entry. But I told myself, today let the market speak, I will only listen. And that day became the biggest turning point of my trading. Now listen carefully. Professional traders watch 3 things in the first 15 minutes. Not candles. The first signal is volume. But not the way you think. Retail thinks high volume means a strong move. A pro trader asks, where did the volume come in? Near the high, near the low, or in the mid-range. If heavy volume comes at the high and price does not move forward, that is distribution. If heavy volume comes at the low and price does not fall further, that is accumulation. The high and low between 9:15 and 9:30 form the market's boundary. A pro trader marks that range. They do not chase outside it. They wait for the break. Retail enters in the middle of the range, with emotion, with hope. An entry in the middle is a grave. The market will either go above the range or below it. In the middle there is only a trap. The third signal's candle structure, which is ignored the most. Retail sees whether it is green or red. A pro looks at the upper wick, lower wick, body size, and where it closed. A small body with long wicks means the market is saying not yet. Now the biggest trap. If the first candle is very large, volume suddenly explodes, and there is news excitement, then there is a 90% chance this is not a move. It is an invitation for your emotions. The market does not pay those who come fast. It pays those who come right. Now honestly tell me, how many times did you enter at 9:16 and exit at 9:20? How many times did you say, I should have just waited a little more? The market gives signals every day, but in the middle of noise, only a calm mind can see the signal. Now the biggest question, if not candles, not volume alone, not emotion, then when should you enter? What is the exact moment when a trade stops being gambling? And what are the 3 conditions that, if even one is missing, you should not take the trade? All of that is in the next part, where for the first time I will give you an exact rule-based answer. When to trade between 9:15 and 9:30, and when to simply watch the market. If you do not know the exact rule for trading between 9:15 and 9:30, then trading at that time is not experience, it is an experiment. And experiments in the market are always expensive. Today I will not motivate you, I will not excite you. Today I will give you a straight, bitter truth. Trading between 9:15 and 9:30 is not a skill. It is a permission, and that permission is given by the market, not by you. I know what you want. You want someone to say yes, buy at 9:17, no, sell at 9:22. But if the market were that simple, every trader would be rich. There was a time when I also used to ask, when should I enter? Then one day my mentor said, before taking an entry, check whether the market is even allowing you to enter. That is where my trading changed. Trading between 9:15 and 9:30 is not the default, it is the exception. The normal rule, no trade. Special permission only if conditions match. If even one condition is missing, no trade. First understand this. The 9:15 to 9:30 high and low is the market's first language. If the market is still moving inside that range, giving false moves up and down, it does not mean the market is confused. The market is collecting liquidity. Trading at this time is like standing in the middle of a moving train. A trade becomes possible only when price clearly moves above the first 15-minute high or below the low and stays there, not just spikes and runs away. What does retail do? High breaks, instant entry. What does a pro do? High breaks, they pause. They watch. Is the market accepting this level? If after the break the candle closes above, the next candle does not reject, and volume is not panic-driven, only then is the trade valid. Remember this, the break is not the signal, the hold after the break is the signal. Now the simplest but most powerful rule, do not watch the candle body, watch the close. What the market shows matters less than where the market closes. If the candle went up but closed in the middle or low, forming a long wick, the market clearly said no. And where the market says no, showing ego destroys accounts. If volatility is very high, the move is news-driven and candles have no structure, then the best trade between 9:15 and 9:30 is no trade. This is not weakness, this is professionalism. The market gives opportunities every day, but not every minute. Now ask yourself honestly, have you ever taken a trade just because the market was running? Have you ever broken patience even while knowing the rules? If yes, the problem is not knowledge. In trading, losses do not come from wrong entries. They come from early entries. Now comes the most dangerous question. When rules break, when patience collapses, when the loss has already happened, in that moment, how do you stop yourself? How do you avoid revenge trading? How do you control emotion when the market is showing money right in front of you? In the next part, I will tell you my most painful loss story and the psychological shift that made me a survivor. The biggest damage in the market does not come from bad strategy. It comes from yourself. And I am not saying this from books. I learned it from my own account. If after a loss you have ever said, just one more trade, this market cannot fool me. If I stop now, I will look weak. Then listen carefully. The The market did not defeat you. Your ego already took a trade against you. I know what a loss feels like. Sitting in front of the screen, chest heavy, heartbeat fast, and one voice in the mind. Recover it now. This is the moment when the trader switches off and the gambler activates. This was the day in my trading career that I want to forget but cannot. The market opened at 9:15. I went against my rules. Took an early entry. Took a loss, not small but recoverable. Inside, a voice said, stop, not today. But the ego said, you are not weak. I took the second trade, no rules, no setup, just anger. The market slapped me again. My hands were shaking. The screen looked blurry. Sweat was coming. But the most dangerous thing, the pain was gone. Now there was numbness. This is the stage where not just account breaks, identity breaks. That day I did not just lose money. I lost patience. I lost discipline. And most of all, I lost self-respect. After the market closed, I kept staring at the screen. There was an option to take 0 trades. But I chose to prove myself. And proving yourself to the market is the most expensive hobby. Revenge trading is not for profit. It is to heal ego, to suppress pain, to refuse accepting the loss. And the market does not accept emotion. If after a loss your next trade is faster, size is bigger, and rules are fading, understand this. You are not trading, you are reacting. I wrote one rule on paper in bold after a loss: no immediate next trade. Mandatory break, 15 minutes, 30 minutes, or the full day. The market is not running anywhere, but your account can. Think honestly, how many times did you take a trade just because you could not accept the loss? How many times was the strategy right but execution emotional? If the answer is yes, you are not a bad trader. You are human. After that day, I did not become profitable immediately, but I became stable. And in trading, stability is the foundation of profit. Now the question is, how do you stop yourself after a loss? How do you keep emotion under rules? How do you build discipline into a habit, not motivation? In the next part, I will give you the 3 psychological anchors I personally built so that losses control my rules, not my hands. Strategy can get you into trades. Psychology keeps you alive in the market. And the one who does not understand this after losses does not last long. Let me be honest. People do not lose in the market because they do not know the rules. People lose because under pressure, they forget the rules. I know what you are thinking. I understand everything. But the moment I take a loss, I forget it all. This is not your weakness. This is the default behavior of the human mind. There was a time when I had the best setups, clear rules, and experience, yet I still made mistakes. Why? Because I had no anchors. An anchor means a mental rope that stops you from being swept away by emotional waves. Before the market opens, I make a contract with myself on paper. Even today, it includes maximum trades for the day, maximum loss for the day, conditions in which I will not trade, and the most important line, the market owes me nothing. I demand nothing from the market. This works because when a loss happens, the mind argues, but written words do not argue. There is one rule that saves me every time from revenge trading. After a loss, minimum 15 minutes gap before the next trade. During that gap, do not look at charts. Do not look at P&L. Just breathe. Emotion peaks in the first 10 minutes. Delay weakens emotion. Then one shift changed everything. I stopped asking how much will I earn today, and started asking how well will I follow my rules today. That day my trading changed. The market does not pay the right trader, it pays the ready trader. One day a perfect setup appeared. Entry was clear. Profit was visible, but I did not take the trade, because it came after my daily loss limit. That day I did not make money, but I won myself. If you think if I had taken that trade, I would have made profit, then listen carefully. The trade you skip with discipline is the trade that makes you profitable in the future. The strongest trader is not the one who trades the most. It is the one who does not trade when it is not needed. When you stay silent after a loss, when you let opportunities go, when you put ego aside, the market does not reward you immediately, but it changes you internally. Now the final question. How do we use all these lessons practically? How do we apply these rules in real market days? And how do we identify whether today is a trading day or a watching day? In the next and final part, I will show you 3 real market days in story form: a loss day, a flat day, a profitable day. So you do not just understand, you see. Trading theory is understood in books, but a trader is built on market days. Today I will not give you any new rule. Today I will show you 3 real days exactly as they happen in front of me. No makeup, no hero story. If you think I know everything, I just cannot apply it, then listen carefully. You cannot apply it because you are reading the market day wrong. Not every day is for trading, but every day is for decision making. 9:15. The market opened with fast movement. At 9:18 the first setup appeared. According to rules, entry was borderline. Heart said it will work. Mind said wait. I listened to the heart. 3 minutes after entry, the market reversed. Stop loss hit. The loss was small, but the damage had begun. This is where 90% of traders lose themselves. And this is where I stopped. I looked away from the screen. Set a 15-minute timer. Closed P&L. I told myself today the goal is not to recover. Today the goal is to survive. By the end of the day, no second trade. Financial loss happened, but psychological win. A lost day ends correctly, not with profit, but with discipline. Next day the market opened, but it was not clean. Candles were small, wicks were large, and 15 to 9:30 range was being tested again and again. Retail mindset kept saying the move will come, breakout is near. I did not read the chart, I read the day. This was a no trade day. The hardest thing is not trading when the screen is on and time is available. End of the day, P&L 0. No excitement, regret. A zero profit day is not failure. It is a filter that protects you from bad days. Third day, market opened. 9:15 to 9:30 range was clean, volume normal. No panic at 9:32 the range broke. This time I did not enter on the break. I watched. Is it holding? Where is the close? What is the retest behavior? 9:36 entry. No excitement, no hurry. Trade moved. Target hit. The real win was not the profit. The real win was this: I was taking only the trades my rules allowed, not the ones my ego wanted. If you think, I wish I could do this too, listen. I am not special. I just accepted one thing. The market was not made for me. I have to become worthy of the market. The truth of all 3 days is one lost day tests patience. Flat day tests ego. Profit day tests discipline. In all 3, the cost of a wrong decision is the same. Consistency in trading does not come from strategy. It comes from correctly naming the day. Now the question is, how do you identify these days live in the morning? How do you know what kind of day today is? And as the day changes, how do you adapt yourself?